Welcome to InvestorHubX.com. Most traders look at a gap on a chart and see just a gap. But very few understand what a gap actually represents and the opportunity behind it. A gap is not just a space between two prices. It's a moment where the market had no choice but to jump. If you want to learn how to trade gaps the right way, hit the like button and let's dive in. In this video, we're going to cover 4 key things. First, what a gap up, gap down, and gap fill actually are. Second, why gaps happen in the first place. Third, why gaps often get filled. And finally, how to trade CME gaps in Bitcoin. By the end of this video, you'll understand gaps in a way most traders don't. Let's begin. So what is a gap up? A gap up is one of the simplest concepts in trading, but it tells you something powerful about the market. A gap up happens when the market opens higher than the previous day's close, so instead of price moving smoothly, it jumps to a higher level. What is a gap down? A gap down is the opposite of a gap up. It happens when the market opens lower than the previous day's close. Instead of moving gradually down, price jumps straight to a lower level. What is a gap fill? A gap fill happens when price moves back to the level before the gap occurred. So if price gapped up, a gap fill means it comes back down. If price gapped down, a gap fill means it moves back up. A gap fill tells you the market could not sustain the new price level. In other words, the move was too fast or based on weak conviction, so price returns to what we call fair value. So why gaps happen in the first place? Gaps happen because the market doesn't operate continuously, especially in traditional markets. Between the market close and the next open, new information enters the system. This could be earnings results, economic data, breaking news, or sudden changes in sentiment. And when the market reopens, buyers and sellers no longer agree on the previous price. So instead of trading step by step, the market jumps to a new level where transactions can actually occur. Think about it like this. At yesterday's closing price, there are no willing sellers anymore or no willing buyers. So price has to move instantly to find the next area of agreement. That's why a gap forms. Not because the market wants to move fast, but because it has no choice. And this is the key idea you need to understand. A gap is not random. It is the result of new information and imbalance. Now in crypto, the market trades 24/7. So gaps don't usually appear on the spot chart. But when you look at CME futures, which close over the weekend, you'll still see gaps form. And that gives us insight into how different markets process information. So why do gaps often get filled? When a gap forms, price moves very quickly due to new information. But sometimes, that reaction is too emotional or not fully justified. So the market does what it always does. It goes back to retest fair value. That's what a gap fill is. Think of it like this. Gap is sudden imbalance. Gap fill is market correcting that imbalance. If price moved too far, too fast, it often comes back to where real agreement exists. So how do you know whether a gap will continue or get filled? It comes down to one thing: the reason behind the gap. If you see a gap up driven by strong fundamentals, like a major earnings beat or genuinely positive news, then price is more likely to hold and continue higher, because the market is revaluing the asset based on real information. But if you see a gap up driven by hype, rumors, or weak news, then that higher price is often unsustainable. And in many cases, price will reverse and move back down, filling the gap. Now here's a key idea most traders overlook. The wider the gap, the more important it becomes. A wide gap often means the asset is overbought, overvalued, and stretched too far, too fast. And when that happens, it increases the probability of a sharp move in the opposite direction, which is why wider gaps often set up stronger gap-fill reversal trades. Now that we understand how gaps work, let's take it one step further and look at something unique in the crypto market: CME gaps in Bitcoin. Because this is where things get really interesting. When you look at Bitcoin on most exchanges, you're looking at the spot chart, and that market trades 24/7. But the chart we use for CME gaps is different, which represents Bitcoin futures on the CME, Chicago Mercantile Exchange. And here's the key. Spot Bitcoin trades 24/7. Bitcoin in CME only trades Monday to Friday. So what happens over the weekend? Bitcoin keeps moving, but the CME market is closed. When it reopens, price has to jump to catch up. And that jump creates a gap. This is why you'll often see no gap on the normal Bitcoin chart, but a clear gap on CME Bitcoin chart. And here's what traders have noticed over time. Price often comes back to fill these gaps. Not always, but often enough that it becomes important. To view the Bitcoin CME chart, head over to the symbol search area and type BTC1 followed by an exclamation mark. Remember, you won't see these gaps on the regular Bitcoin chart because that market trades 24/7. Now, let's look at some examples. This is Bitcoin CME chart in the daily time frame. How many CME gaps can you see? Pause the video for a moment and have a look. All right, these are all the gaps I can see on this chart. How many did you manage to find? Now here's what's interesting. Every single gap here has eventually been filled. But remember, this doesn't mean all gaps will always be filled. If you find this helpful, please visit InvestorHubX.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. In summary, today we've covered what a gap up, gap down, and gap fill are. We've understood why gaps form and why they often get filled. And we've explored CME gaps in Bitcoin and how they can give us deeper insight into price behavior. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.